All right, everybody. We're going to talk about three important sectors to be watching this week of trade and heading into next week that can have an incredibly huge impact on the S&P 500, two of which are incredibly important. One I find interesting to keep a close eye on for 2023. We're going to get right into it today. You probably, if you're watching the market, saw a lot of volatility. That was derived here from a lot of major reports from the FOMC minutes to JOLTS to ISM manufacturing, created a lot of volatility in the overall S&P 500, as you can just see this wild amount of trade. We were about break even towards, the last 30 minutes of trade, and then we just got some rip your face off type of rally. And, we've been seeing these type of rip your face off rallies, and they've been getting obviously reverted back down. So we'll continue to watch this chop and volatility. It doesn't seem like it's going anywhere. The 11 sectors that make up the S&P 500 were all up other than energy. Now I'm going to talk about the three sectors to watch. I'm going to point two of them out right now. That's going to be energy and it's going to be financials. And I'll get into the reasons as to why that will be. Now, technology was also, an important sector to pay attention to. Technology has been getting hit. Now, we talked about technology names really yesterday in communication, right? We talked about Tesla. We talked about Apple. Tesla was up 5%. Apple was up 1%. Why? Well, they came down to their lower weekly expected moves, got completely obliterated, and we're seeing a little bit of a relief bounce. Microsoft is what really held the performance down in the NASDAQ. Okay, really helped, or not even the NASDAQ 100, I should say, and then the S&P 500. Okay, so that's what really crushed the performance today overall. This one and then this one over here really held the Dow down, which is UNH. Okay. Now, why is it so incredibly important to pay attention to financials? We're going to start with financials. First and foremost, next week, we got financials reporting earnings, okay? Not only do we have them reporting earnings, we have large macro data drops coming out next week too. So next week, expect more volatility, expect a lot of craziness. Be aware that these earnings reports will be dropping and when they are dropping, okay? So let's get into a little bit more of the financial kind of sector and why it's important, or what other important aspects we should be watching. So heading into this next week, let's take a look at yields and yield curves. As it stands right now, we have yield curve inversions, which means the short-term yield is above the longer-term yields. And you can see here, the 10-year, 2-year, it dived even deeper today. We talked about that one the other day, right? So we're looking at 67 basis points inverted. The 10-year and 3-month, what is going on? 86 basis points inverted. This thing is pointing straight down. It honestly looks like it's going to hit 100 basis points at some point. Absolutely crazy. Now, we know that the financials have a huge impact on the S&P 500. Energy has a huge impact on the S&P 500. You might be wondering why. Well, it's because some of the names in the financials and energy, they hold in the top, 15 as far as market cap goes in the S&P 100. Now, something that I found interesting was when watching the yield curve. When the yield curve was deep and diving into inverted territory, there was a period in time in July and August where we started seeing a rip up in the SPY. And it was like, okay, so what's going on here where yield curves getting inverted, SPY's ripping? Is this just a bear market rally and this is giving us some insight? Well, guess what? It sold off to the downside. I was like, maybe that's not always the case. Well, the S&P 500 started ripping again, right? The next bear market rally, and the yield curve started inverting even deeper, hitting under 80 basis points, more than 80 basis points inverted. Okay. And then was that giving us insight? Well, guess what? Then we sold off again. Okay. In the S&P 500, which is the purple line. And now we're starting to move up and now we're starting to move back down. So what I find interesting here is now I'm starting to see this point back down while S&P 500, it's really just in a trading range, right? We know this. And if it does pop up to this 3,900, potentially even more, is this going to continue to point down, giving us some insight saying, hey, this will probably potentially get faded? I couldn't tell you, but what I can show you is what happened the prior times that took place. Now, we were discussing financials, okay? Why is it important to look at the yield curves? Why is that, why is it important? Well, banks, simply put, they borrow short and they lend long, okay? So why would a yield curve inversion be bad for banks? Banks earn net interest income by charging borrowers higher long-term rates while doling out smaller interest rates to depositors. Now, when the Fed is raising rates, what does that encourage? It encourages typically saving, right, and less spending, right? Typically when interest rates are down, that fuels bubbles because people buy things that they otherwise couldn't afford at a higher interest rate because the payment is lower. And that's what fuels things. And now with rates flying sky high, what are we seeing? Well, we're seeing interest rates for depositors at like 3.3% to 4% right now. And people are taking advantage of it. I know plenty of people, myself included, that's like, okay, well, the market's very volatile, so maybe I can just trade with a lower amount and move cash into one of these accounts to earn yield. And that is what I do in volatile markets. Okay? And by the way, you can trade with less capital in volatile markets and still have excellent outcomes. It's amazing. Okay. So financials, that's why it's important. It doesn't look good for the bank. So it's going to be a very interesting earnings week when it's out. The next one is going to be obviously energy. Why? Well, take a look down here. Boom, CVX. Boom, XOM. Boom. This is the top ranked market cap names in the S&P 100. It's stacked rank. So Apple back to 2 trillion. Woohoo! Right on that little bounce. So we'll see here if that continues or whatever the case is. Now, XOM, it's not too far off, right? We have 1, 2, 3, 4, 5, 6, 7, 8, 9. It's number 10. And we also have Berkshire Hathaway. All right. So these are large market cap names in the financials. So when we start to see, sorry, that's the financials. We're talking about XOM. We're talking about energy. I'll stick to that. This is what I find so interesting is because energy today was rather flat. Okay. And that could be potentially because it came outside of its lower weekly expected move, which we discussed yesterday, and then came back and tagged it and pushed back away from it again. But this is what I find interesting. Oil was down 5.32% today. It got smashed. So are we going to see, that was just a brutal distribution day. You can see it in the volume. Absolutely crazy. But, there's a strong correlation between oil and also energy names. So if this continues to crack, energy could be one to watch very closely for more destruction. Okay. Now, if we take a look at this chart, this is a monthly time frame. I'm using a 12-period rate of change, so a yearly rate of change. Most recessions have been preceded or by oil crashing. And what do I mean by that? 1987 crash. Okay, you can see the rate at which oil rose reached up to a very high level. So oil was moving at a rapid positive rate of change, and that preceded the 1987 crash. In 1990, we saw a massive move in oil, which preceded the 1990 crash, leading up to the dot-com bubble, right? People think, it's just tech stocks. No, take a look at oil. Flew through the 100 marker right here. Okay, that preceded the dot-com bust. Financial crisis. Boom. Oil rising very rapidly. Now, what I pointed out here, and I pointed out many different times, was this specific chart when it was started cranking up like crazy. Like this is the highest we've seen it at this level of rate of change. So we're talking a huge move, and that could be because obviously where it came from. All right, it plays a part. But we came from here, boom, boom, and now we are going into negative rate of change territory. A little bit deeper today, so we'll see how the month finishes, right? This is a monthly basis, and this is the start of this month. So who knows? Okay, but moving into negative territory, this could tell me, hey, demand destruction, recession on its way, or potentially something like we've seen here on these other things. I don't know what the name is going to be, but it's something to pay attention to. Okay, and if I take a look at just energy names overall, this right here is known as the spaceship pattern. No, I'm just kidding. But we did talk about this rounding top, and then we got that crackdown, right? We thought it might come touch a 200-day, right? It's still in an overall uptrend. This could be an inverted, cup with handle pattern. The reason why I have it highlighted here is because this could be a potential pivot point where if it does break down, that could cause some more selling to take place. Right now, we're just in a period of consolidation, but we did see a big distribution day the other day. The MACD is below zero and curling itself over. So this right here, if it starts cracking, we could see a pretty strong move, and it could potentially even come to fill this little gap right here, that, island reversal pattern that shot us right up here could come right back down to that area. And like I said, energy is going to be an important sector to watch, because if energy cracks and you take a look at some of their holdings, right, the big names, that can have a big impact on the S&P 500, especially if financials start reporting poorly and the market perceives that as bad news and they start to sell off. Okay. A couple other things. Yeah, PMI started. We got that PMI report today, cracked even further down into the kind of that recession territory. And that matches really close to that copper to gold ratio, which we discussed on the prior video. That looks like it's going to start pointing more down. Yeah, gold started outperform definitely copper, as we've seen. I'll pull up the next sector here momentarily. The last thing I want to pay attention to is this dollar, right? We're both consolidating here very, very tightly. So I think we're going to be getting a break, right? Last video, we talked about it's about to break. And let me tell you, it is about to break. It might just take the start of earnings to do it, but it could be as soon as tomorrow or this week. All right. The next sector is going to be, I'm going to say it's kind of a hybrid, right? Silver, gold, and then also an important one to watch is the miners, and I'll explain why. So silver was actually down today. This is an important aspect that I want to point out here is it was down 1.12%, negative divergence, rising wedge, some not the greatest looking candles here at the particular point in time, right? You have long upper wicks, and then they're kind of like rallying up, but then closing. So the bears just kind of keep pressing back at this 24.50 to 25 level. And maybe it needs to still take a break, but that could present itself opportunities to go long. Now, this is GDX. Remember, silver, GDX. GDX is miners. So miners broke out of this pivot area, and people honestly might look at this and be like, oh yeah, it was great volume. We had that crossover on the PPO and RSI is pointing up. This thing looks like it can start actually really moving. Okay, it might move. You know, we have prior areas of resistance up here. It's always a possibility. But I want to show you something. The silver thing has me a little worried about just entering long randomly at this particular point into miners. I would prefer a pullback. Let me show you. If I overlay the miners to silver, understand that these things correlate almost perfectly. Almost perfectly. They correlate literally 100%. So when I see silver taking a hit, but yet miners are going up, is silver giving me the heads up that if this starts heading down, miners are going to start to pull? It's a possibility, and it's something that I want to pay attention to after these enormous runs already. Remember, people like to buy and chase big moves after the fact that they happened. Another thing that I want to pay attention to here is the gold miners bullish percent index. A while ago, we pointed out this positive divergence. Boom, started moving up, coming into that overextended territory potentially. Still not overbought by any means, but it is subtle divergence here. If you look at the price of the GDX, and then you see these divergences in the RSI and also the BP chart itself. The last one here is gold, and gold has been also on this tear. It broke through this little pivot, so maybe people are chasing this one up. Still a negative divergence here too as well. Seeing some good volume though too. So I'm still looking to, I have gold. I've had it for a while, so it's nice seeing this recovery. I would like to add more of a shorter term trading position on a pullback. So that is what I'm looking for going into 2020. Now, I don't think that these are going to have any huge, large impact on the S&P 500. That's why I said those two sectors, energy and financials, will be important to watch. Okay. Let's continue on. I want to look at a few indicators. The NASDAQ summation index starting to curl back up, so we're going to see it here on some good breath here on the NAMO, the NASDAQ McClellan Oscillator. This thing is curling up. Maybe the parabolic SAR potentially starts underticking, which could identify a potential change in trend, which could mean, hey, we might actually see tech rally. So even if we see financials come off and energy come off, if tech holds up strong and comes out of these oversold conditions, well, actually, maybe there might just be more of a mute type of market still and more of a stock picker. If we take a look at the summation index for the New York Stock Exchange, also curling back up here, we'll continue to watch that. And the traditional NYMOT is getting some positive breath there too as well. And we also got some more, got more new highs versus new lows, 45 of them in the NASDAQ. So that's a positive sign overall, but I'm marking them because a lot of times we started getting positive breath at peaks, okay? And then it started selling up, and now we're starting to get positive breath towards a low. So this, I'm interested to watch. It's not an exact place where I'd prefer shorting, but you got to be open to it if it starts cracking these. Like if I were to invert this chart, people would look at this like, hey, it's just trading range, right? After a move down. So if we, break down from this, this could create another leg potentially down. Well, we'll know a lot more when earnings season for big tech and stuff comes around. Another thing to pay attention to here is growth versus value has a rate of change positive divergence, has an RSI positive divergence. When it crosses up through zero, that's a little bit more bullish, but when it goes from positive to negative below zero, I mark that on the screen. All these red lines mark that when that takes place, we see rate of change and we see this drop off. This was the biggest one that we caught right here, was when we pointed it out. This thing just sold off like a rocket ship to the downside, and we got in a couple of them. The most recent one was right here, and now it would be nice to see it, obviously, from a bullish perspective, cross back above zero. But in order to do that, we like to mark off overextended areas and positive divergences that could potentially lead to some sort of rally in growth versus the value. Now, this chart that I'm showing you right here is the Qs. The growth versus value relative strength line, it's actually hidden. A couple other indicators, bullish percent on the NYSE, also a positive divergence showing off right there. And we started to see a pretty strong move. Remember, once again, in the New York Stock Exchange today is one of the stronger performers. So perhaps this might have some action behind it. A couple bottom finding indicators where we find long-term bottoms. I found this kind of interesting. When the NASDAQ record high percent index crosses below this 20 marker and back above 35, this was pointed out by a trader, Devin Knepmer. I know I'm pronouncing his last name wrong, but it's a very hard one to pronounce. When it crosses back above the 35 marker, it has marked some significant bottom. So this was long-term capital management when it blew up, and then all of a sudden we rallied like crazy. Well, then we also had right here too, this was the dot-com bust, and then we started marking the bottom. It's not perfect, but it was right here. And then over here, I'm just calling out 2008. It did right here finally cross back up through it, and that marked out the bottom pretty well. But there was a time where it actually came back up, potentially tricked folk into believing that, hey, this could be done with, and that was that rally right there. And we've seen a lot of these bear market rallies, and then it went back right back down, and this is what really set off the financial crisis. We have over here, over here, over here, and the reason why I'm pointing this out now is because, hey, we're starting to crank it back up. So are we going to potentially get above that? Hey, things are looking good, and then it'll cross back down, and then it's going to start get another third leg. It's always a possibility, but it's a positive thing to see this. It would be nice to see it cross back above 35. Another one here is the Cohen high low. This has also been choppy back in 2008, but it does mark short-term bottoms, and then it marked this bottom, and then it marked that bottom. It also marked right here in 2016, right, during the 2015, all that stuff that's been taking place. We had the Christmas Eve massacre and marked that bottom, and then we also had the pandemic bottom reached right here when this reads down to 0.05 and starts bouncing from those levels. This looks very similar to 2008. As you can see, there's multiple times it hit, and then it marked short-term rallies, and it's pointing right back up right now. Week's not over, so we'll see how it finishes. But the most recent one, it was right here. So, hey, wouldn't it be funny if this thing started cranking back up and that was a potential bottom? That's not really a prediction by any means, because anything can happen, but I wanted to point that out for all of you. The last couple of things I want to point out is some defensive sectors, a little bit of a red flag here on consumer staples, and that is consumer staples relative to the S&P 500. Okay, so it doesn't mean that it can't go up higher or can't go down, right? This is just relative performance, and as you can see, we are cracking up to some, new highs, really. And during that process, we're also putting in a negative divergence on the RSI, negative divergence on the rate of change. Why is that important? Consumer staples, this was important leading into 2022, the entire year. So from 2021, right, this was something that I was talking about way back when. You'd have to go fact check it, but there was a positive divergence in the rate of change. There was a positive divergence on the RSR we're calling out, and we're saying, hey, leading into 2022, consumer staples could be one of the performers. And consumer staples, sure as heck, it wasn't a strong performer, but if you were in consumer staples, you didn't lose a lot of money, right? This was giving us insight that's saying that, hey, if this starts raking up, yeah, perhaps people are going to go to safety, right? Versus, the mega caps. And that's exactly what took place. Another one is Michael Guyad's utilities over SPY. This right now is telling us that, hey, it's risk off, but it is pointing down from a rate of change perspective. So if it starts crossing down through zero, that could indicate risk on. So that could be a potential positive sign for risk assets. But as it stands right now, utilities is kind of like the more safety trade, but it is the relative performance is pointing down. Last thing I want to go over is the zones. Very quickly, we talked about gold, right? Gold is still up there in the red. That means it's at the higher range of its zone, which says, hey, I don't really like to buy there. I'd like to buy more towards the lower end on pullbacks, and we're just not there at this particular point in time. Financials is another one. You can look at XLF, you can look at KRE. Remember, they're reporting next week, and currently they are at their higher end of the zone. So that's kind of interesting to me. It's going to be I just find it interesting to see how that plays out. But that is also at the higher end. And then we talked about oil getting absolutely crushed. Well, and energy didn't really follow, but oil is at its lower range of the zone. So, I'm a little curious to see how energy is going to play off on after today's trading candle. We'll go over that really quickly once again, how it gapped down, but then we started to move up a little bit. So, being at I'll pull up XLE on the zones now so I can show you. If we take a look at XLE, what do you know? It's actually towards the lower range of its zone too. So to see potentially energy bounce a little bit, potentially oil, at least stabilize a little bit before we get some more action, it's always a possibility. But gold as it stands right now and financials have me, it's not something that I'd be looking to go long at this particular moment. That's all I got for you, everybody, on today's Stock Market Brief. See you later.